In this last video clip, I'm just going to cover the intergroup transactions and balances that are owed, and for question 1812, and then focus on the NCI effect of the intergroup transactions. Now, there's basically three things to consider with regarding to the intergroup transactions. There were the dividends that were paid and declared by the subsidiary, and then inventory that was sold by the subsidiary to the parent company in the previous financial year as well as in the current financial year. Now, first of all, regarding the dividends, this is just your normal straightforward consolidation worksheet entries regarding the parent share in the dividend, and the aim of these adjustments are to eliminate the parent share of the dividends, because ultimately any dividends that are included in the consolidated financial statements should only relate to the dividends that are due to external parties. So with regards to the dividends that were paid in the current year, we reverse that the parent share, so reversing the revenue that was recognized in the parent's accounting records and reversing the dividend paid in the subsidiary's account. Now, you might say that the net effect of this on earnings would be zero, but if we don't do this reversal, the dividend revenue and the dividend paid from a group perspective would be overstated. Okay, so only the parent share, because the NCI share has been adjusted against the NCI to reduce the NCI, to reflect the fact that by receiving the dividends, they have less a share in the earnings, being compensated for that decrease in their share in earnings in cash through the dividends that were paid. With regards to the dividend declared in the current period, we've got two legs to that transaction. First of all, in the subsidiaries account, there's a credited dividend payable, and then the then the dividend declared, the expense. So we reverse that transaction with the parent share of that dividend, and in the parent's account we reverse the dividend revenue against the debtor that was created. Okay, let's look at the other two intergroup transactions. The first being the unrealized profit in the opening inventory. Now, with intergroup transactions, it's and where there's NCIs in the picture, always just remember that whatever the adjustment in the intergroup transaction is against the earnings of the subsidiary, a similar adjustment would be made to the NCI. So the NCI moves in line with what happens in the earnings of the subsidiary. So in this case, and I'm not really going to focus on the intergroup transaction per se, because we've covered that in other video clips. This is the standard entry to pass on consolidation where there's unrealized profit in the opening inventory, based on the assumption that the inventory is then sold in the current year, and through the adjustment on the cost of sales line item, the realized profit is brought into account. Now, once again, in the solutions, you've got a combined effect of the NCI adjustments. Maybe if you want to split it out to make more sense, let's deal first with the adjustment against the opening retained earnings. So The opening retained earnings is reduced with the unrealized profit that sat in the opening inventory and that was recorded as profit in the subsidiaries accounts in the previous financial year. So the effect of that adjustment against the opening retained earnings is that retained earnings is going to reduce with that entry. So because the retained earnings reduces, the NCI share in retained earnings should be less. So the NCI adjustments that we pass really just reflect that movement in the equity of the subsidiary. So that first part would then be to say debit our NCI to reflect the fact that their share in the opening retained earnings is less, credit the retained earnings opening balance with 280, 20% of that movement in the retained earnings. Looking then at the entries relating to the current year and the realization of the profit in the inventory. So that relates to the current year. The net effect of that, that 600 chance should be on that side. The net effect of that is an increase of 1,400 in the profit for the group in the current year. So earnings is going to increase on a group level by $1,400, and the NCI is entitled to 20% of that increase. So the entry would be debit NCI share of profit. So we move it out of the profit for the group and disclose it as NCI credit 280. So those two cancel out, and that is how you get to that combined adjustment for the NCI. Let's look at the unrealized profit in closing inventory. So this is our inventory that was sold by the subsidiary to the parent company in the current year. Once again, you should be familiar with the normal consolidation adjustment to reverse that unrealized profit from this transaction. So from a group perspective, the sale never occurred, so the cost of sale should also be reversed, and inventory should be reduced to get it back to the cost, the initial cost of the inventory from a group perspective. Because we adjust the carrying amount of an asset, we've got the deferred tax implication, raising a deferred tax asset. So if we look at that intergroup reversal transaction, let's identify where earnings is affected. So that's an income that is reduced, cost of sale that is reversed, income tax expense that is adjusted. So those three accounts are all income statement accounts. So it affects the profit of the subsidiary for the year, but we now view this from a group level. So the net effect of that is $1,000, it's $700. Okay, so that's 1,000 less the income tax expense, so it's $700, the net effect, and it is a 700 debit to the income statement. So therefore the earnings of the group is going to decline or decrease by $700, and therefore because the earnings is going down by 700, the NCI should move in line by at 20% of the 700. So the NCI reduces at 20% of the 700, and their share of the profit is credited to show that that the reduction in the NCI is reversed back to the share of the profit. Because in the first part of the step 3, we've included the profit of the subsidiary before these adjustments were made, so we just reverse the NCI that we've created on the higher profit amount to reverse it back to the income statement. Okay, so I hope you see after these video clips that the NCI really just moves in line with the changes in the equity in the subsidiaries' equity figures. Be careful to look at the direction of the intergroup transactions, because there's only an NCI effect if the profit or loss was recorded by the subsidiary. So if the subsidiary sells to the parent company and there's unrealized profit, then the NCI will be affected. However, if the parent sells to the subsidiary, the profit was recorded in the parent company, and therefore there's no NCI. So just make sure that you're clear on the direction of the transaction from the subsidiary sold to the parent company. Okay. If after these video clips there's still something you're not clear on with regards to the NCIs, feel free to post a question on my Guru, and we'll be able to respond with a more detailed answer.